Thank you, John Cunliffe, for joining us. So John is the Deputy Governor at the Bank of England. He has been there for roughly about 6 to 7 years. He has a lot of things that he's kind of responsible for, including financial stability, supervision and oversight of market infrastructure and payments, international issues. And so with that, in that context, and given what's been going on with COVID, John had given a very interesting speech a few weeks ago in which he talked about kind of evaluating the financial system in this during this crisis response, and also looking at what are some vulnerabilities and maybe some weaknesses that have popped up as this crisis has been going on. So I thought that it would be a good place to start. So John, if you could talk a little bit, maybe summarize some of the thoughts you gave in that presentation you gave, and also maybe some things that you've learned so far during this crisis. And thanks again, John, for joining us.
Okay, look, thanks. Good afternoon, or whatever time of day it is for you. And thanks again, Clay, and to the IAF for the invitation. The best place to start, I think, is that this crisis has been the first real stress test of the financial system since the great financial crisis 10 years ago, and in a sense a test of how well the reforms that we put in have operated under stress and what have we learned. And I'd make a couple of general points at the outset. That the crisis isn't over, and I don't think stresses in the financial system are over either. So there are more things to happen, and there's a very large amount of uncertainty about the path of the pandemic, the policy measures, and how that will impact on economies around the world. But we have seen an initial phase where the world economy, sort of the economic prospects of the world economy, shifted very suddenly in March, and financial markets and the financial sector then reacted to that. And what we saw was initially a flight to safety, sort of things you would expect to see, search for liquidity, and safe assets and safe haven assets going up in price, yields on bonds, government bonds going down. And then somewhere around about the middle of March, that flipped into what some people have called the dash for cash, when liquidity just broke down, not just in sort of markets that we knew might be illiquid, but right across the board, and including in the core funding markets and the core government bond markets. And suddenly the opposite started happening, and government bond prices started falling, yields were going up, and we started to see dysfunction in core repo and core funding markets. And at that point, central banks stepped in to support markets, and they stepped in with very large amounts of asset purchases. Depending on the jurisdiction, they also stepped in across a range of markets, either by buying assets directly or by accepting assets in central bank operations, just widening their eligibility criteria. Now, since that intervention, things have calmed down and markets have come back again. They've recovered a great deal of the lost ground, the ground they lost in that period. And the interesting question about how markets are now pricing risk and risk going forward. But we had a very valuable lesson about what could happen and just how the financial system sort of jumped to illiquidity in a very short period of time. And I think we should try and learn or take out of that some initial lessons. And it's important to try and do it now because there's more things to happen. But while those insights are fresh, maybe just record the things we should look at afterwards when this crisis is over. And I'd say make two other framing points here. One is that this was a tail event. This was a pandemic that we hadn't seen before across the global economy. And secondly, this was not something that originated in the financial sector. This was something that's a kind of exogenous event to the financial sector. And so in that sense, it's different to the financial crisis, which originated in failings in the financial sector itself. But of course, since the crisis, we've tried to make the financial sector resilient, not just to problems that it generates itself, try and stop it generating stresses, but we try to make the financial sector resilient to tail events, wherever they originate, because when the financial sector breaks down, then the economic damage is huge. And the question is, do we have that resilience in the system? And the short answer is, I think we have it for banks. You could do a thought experiment, which I pose in the speech, of imagining a kind of repricing of economic prospects and asset values with a pandemic had occurred in 2006. It probably would have knocked most of the advanced economy banking system over, given the weakness. This time, the banking system has, initially at any rate, been able to support the economy, but not cut that credit in the way that we saw 10 years ago. I do think, however, some questions are posed on the market-based finance side about whether taking the system as a whole, we have a system which generates liquidity stress and severe liquidity pressure under admittedly very stressful conditions, which then requires public sector intervention. And the analysis has not been done, and I think it's very important that the official sector, working with the private sector, tries to go through those events in March and think about what actually happened in the system and the chronology and how the various parts of the system interact. And then I think we have to ask the question, do we want a system which jumps to illiquidity and requires central bank intervention at that scale? What are the dangers of that? And what are the costs of putting in more resilience? Because as we've discovered with the banking system, you can certainly put in more resilience, but it doesn't come for free. And there's a cost in terms of just the cost of financial intermediation that comes to that. And then very quickly, Clay, because it was a long speech and I can't squeeze it all into a short session. I think the things that one needs to look at is the system as a whole and the interaction between the various elements. So some markets jumped to illiquid, became illiquid very quickly. We've known for a long time, and I think the market has known, that high yield corporate bond markets, emerging market debt, there isn't the dealer intermediation there, there isn't the liquidity there under stress. And compared to the kind of big lit markets like the equity markets, those markets become illiquid very quickly. We saw sizable redemption flows from funds. Funds used mechanisms that they have to control those flows, but there was clearly some demand for cash and liquidity coming out of that universe. We saw some hedge fund strategies that seemed to accelerate the pressures for cash, particularly hedge funds trading, making arbitrage trades on the difference between cash instruments and the derivative basis trades that should be fairly low risk arbitrage trades in normal times, as the basis widened between the derivatives and the underlying cash instruments and margin call kicked in. Some of those strategies had to be unwound very quickly. We saw margin call play a role, and margin call is necessarily pro-cyclical because as asset values change, margin changes. But it's clear that a number of participants in the market weren't really prepared for what could happen with margin call under stress. And there may have been some examples of margin call that was what I would call unnecessarily pro-cyclical, because either the margin models have been undercalibrated in good times and they were catching up, or because extra features in the models were kicking in. We saw dealers just not have the intermediation capacity that they'd had in the past. Some people have ascribed that to regulations, some have ascribed that to risk aversion, and dealers were going beyond their risk limits and they pulled back quite quickly. I'd say at that point, I don't think the answer to one set of stresses is to create stresses in other places. And one of the things we didn't see were dealers coming under severe stress themselves and needing to be bailed out. So I think one's got to be careful about solving one problem by moving the problem elsewhere. And we saw repo markets and core funding markets fail. We may have had a a canary in the coal mine in October of last year in the US Treasuries markets, but there's something in the repo markets seems to suggest that when there is a big structural shift in the demand for liquidity, those markets don't those function. And there are some other things in ETFs and high frequency trading I could mention. I think one's got to put the whole lot together. Look at how the parts of the system interact. Look at whether in the things I've mentioned there are amplifiers that actually make procyclicality sort of amplify the impact of the cycle, and then ask, well, what would have happened if central banks had not stepped in, and where would this spiral? Because as asset prices went down, people sold, prices went down further, more margin call. Where might that spiral have ended? And then to ask the question, well, do we need more resilience? And if we need more resilience, does it come in the supply of liquidity? Does it come in restraining the demand for liquidity? Does it come in taking out some of the amplifiers? And it's important just to put all those things on the record now so that we come back to them properly at the end of the crisis. I'll stop there and keep my answers on the next questions a great deal shorter. Thank you, Glenn.
Thank you. I mean, look, I had asked you for a summary of something that's huge, and so I thought you did a great job of doing that. And to summarize your summary is that basically a lot of the banks have proven resilient. The system over the last 10 years of regulatory kind of interchange internationally has done a pretty good job. But there are things that need to be explored more. So in this last aspect that you talked about sort of the non-banking financial sector, is your thought that this? I mean, I know you said like we need to study it a little bit more and so forth, but is it a systemic issue, or are these kind of the theory that this is market risk? And yes, some either entities or strategies got into trouble, but so what? And so instead, is this kind of, do you think it's affecting the overall system? I guess these vulnerabilities that have popped up a little bit over the last 10 years.
Okay, so I think there are two parts to the answer. The first part is that market illiquidity, something that market participants need to take into account. As you say, some strategies fail at times of stress because not all markets are liquid. When that jumps from market liquidity to funding liquidity, so people now can't transform collateral into liquidity as they would expect to do. So they hold the collateral, they expect to be able to transform it into liquidity to meet margin call or just for precautionary basis. And the markets that would normally provide the liquidity against high quality assets break down. If that stress is coming out of a market illiquidity further up the chain, then the two things are connected. The system is not sort of compartmentalized, that what happens in one market doesn't bounce on. There's anecdotal evidence, for example, I've heard from a lot of participants that some of the selling pressure in the equities markets was because funds could not sell bonds in dealer intermediated markets. So they sold the more liquid thing, equities, instead. And some of the bounce back in equities was people rebalancing their portfolios when the bond markets opened up and became more liquid again. So I think we shouldn't try and separate different segments. In the end, one thing knocks through to another. The second part of the answer is, and that's systemic. When it reaches a certain level, it's systemic, and it surely reached a certain level in March, and that was a systemic stress. Second point I'd make is if your financial system depends for credit intermediation upon market-based finance rather than bank-based finance, and basically credit breaks down because the markets can't operate in the risk, then market illiquidity becomes systemic for you because you depend in economic terms on those markets working. And I think I don't want to sort of draw distinctions between different jurisdictions. I think in the US, where market-based finance is just much more important in the corporate world, it's important in the UK, but not to the same degree. When you saw corporate bond markets become not just illiquid, but closed to new issuance, then you get into a question of, do I need to support markets in order to maintain credit to the economy, which is some of the same issues that we had for banks 10 years ago. We need to support banks because they provide credit to the economy in stress. And if you cut off credit in a stress, then you make the stress much, much worse. So I think there may be different arguments for supporting the market liquidity point. But in the end, the system is one system, and a shock in one part or shocks in a number of parts just feed through to the rest.
No, that's excellent. One of the issues I know that, a number of regulators around the world have raised as a concern over the last few years, and I know that in the Financial Stability Board context, it's been part of the vulnerabilities exercise, is whether or not leverage lending, high yield markets, whether or not that was going to add to the stress because there are less liquid assets. Now, you made a very good point about, like, if the system kind of veers towards illiquidity during crisis, maybe, that's kind of an overall problem, but do you have any judgment, I guess, as to how the leverage lending market and the high yield markets have kind of adjusted during this time? Or is it basically they kind of just when the central banks flooded the zone, that kind of put them so they weren't really as much of a problem as folks had been envisaging? Although one aspect of it is that they never grew to be big enough to be a systemic problem. So anyway, I just, if you could comment on that a little.
Yeah, so I think, sorry if I just take some water. I think on the leverage loans and on all of this, the full story has not yet been told. We have to see what happens at the back end of this. But high yield markets, I think, spreads widened to 700 basis points under stress. They came back both with central bank support to the underlying risk-free and investment-grade markets, and also in the US, some intervention in the high-yield segment. I don't know what would have happened. The counterfactual is difficult, so I don't know what would have happened had there not been support for those markets. I think maybe one indication is that emerging market debt took an awful lot longer to come back than high yield. I think it's stabilized now. You might be able to, it's too early to take a conclusion, but there might be an indication there that where there was less central bank action, which is true of the emerging market side, actually markets remained under stress for longer. On leveraged loans, that market hasn't really come back yet, as far as I can see. I think on both high yield and leveraged loans, this crisis is going to stress the more vulnerable companies. And a number of corporates are going to need to access finance to get through the period when they have no or much reduced revenues because they're not operating. And the companies that I think are going to find it hardest to access that sort of finance are the companies with high leverage. And already before we had the COVID crisis, we could see that companies with high leverage were a much greater proportion of debt than had been the case before the financial crisis. So the amount of leverage in the corporate sector had grown, or within the leverage in the corporate sector, the proportion of highly indebted, sort of 5-6 times EBITDA, had grown. I think also something like 50% of the indices were triple B, and a deterioration in credit quality. And then, of course, the actual loans themselves, leverage loans themselves, have much less creditor, covenant-light loans, much less creditor protection and stress. I would imagine that we are going to see a number of credit events and defaults in this crisis as we go through it. And it'll be interesting to see how those markets react to those defaults, because you'd imagine that the credit stress. So the credit market stresses will be concentrated in the more vulnerable companies. I saw a number, and at the moment the ratio of negative downgrades to upgrades of corporates in the highly indebted and high yield markets is something like 43 downgrades to every upgrade. That ratio was about 8 or 9 to 1 in the financial crisis. So there clearly is a lot of credit impairment coming in those markets, and we'll see how we react. What would have happened without public support, I think difficult to know, but my guess is we'd have seen the stresses go on for longer and the markets remain closed for longer.
Okay, thank you. I'm going to use that a little bit, and also actually really a question from the audience as a switch to more classic kind of monetary policy type questions. So an audience question that I received was, could you see negative rates working within the UK banking framework? So I'll just expand a little on that question, which is obviously there's been a little bit of discussion from the Bank of England about negative rates. So how do you see that question? And also, given the context of what you just were talking about, which is if you have deteriorating asset quality, bank profitability is going to be in question anyway. How would negative interest rates potentially affect something like that?
Okay, so look, I'll say what I've said before, and I'm afraid there's no news in it. Actually, I'm not afraid there's no news in it. There's not supposed to be any news in it. All monetary policy authorities sort of keep their tools under review. In the Bank of England, we reviewed the effective lower bound in 2016 and decided we could bring the effective lower bound down. And at a time like this, when huge uncertainty about future path of the economy and its need for support, it makes even more sense to keep things under consideration and not to draw any kind of dogmatic lines or reject certain things or certain tools on principle. So we've said this publicly, we're doing work on negative rates when we're looking across the whole range of our tools. But the question there is, first of all, kind of general effectiveness, because we know that negative rates have had different effects in different jurisdictions. To some extent, they're probably state contingent, as all monetary policy is. So you really have to ask the question of what do you expect from that particular instrument in the very unique and unprecedented conditions that we have now with the pandemic crisis. And then you also one also has got to ask the question, I think, which motivated the question from the audience, which was, given the financial structure, and financial structures are different in different jurisdictions. Given the financial structure, what difference does that make to the impact of negative rates? And that's a particularly acute question now, because we need the financial sector to be supporting the real economy. So the last thing one would want to do going through a stress is to wind up with a financial sector that either couldn't support the economy or return to stress in some way. So those things all have to be put together. And I don't know the answer. And one shouldn't take from what I've said that we are going to do negative rates, and one shouldn't take from what I've said that we're not going to do negative rates. But we're looking at just these questions of effectiveness in these conditions and in the conditions of the UK and its financial system. Make one other point that as well as that set of issues, there are operational issues around negative rates that we've seen in other countries. So it's something that if you want to do it, systems have to be changed. There's a period of preparation that would have to happen in the private sector. And we haven't asked the private sector to start making those preparations. I think we'll try and come to a conclusion on the instrument before going down that path. But that's where it stands at the moment. and this work will continue until we get to a conclusion.
So let me one follow up, and again, it's a question from the audience. And it's a follow-up sort of on the tools, I think, is so Governor Bailey recently said in an op-ed that when the time comes to withdraw monetary stimulus, it may be better to consider adjusting the level of reserves first without waiting to raise interest rates on a sustained basis. Do you have a view on that, or is that just kind of Governor Bailey's view right now, and that'll have to be explored over time?
So I think that has to be explored over time, and I think that's what Andrew Bailey was saying. And it goes back to this point about, we're in a sort of situation that we haven't faced before as central banks and kind of authorities responsible for economic policy. And I think you need to look at the range of issues. It goes back a little bit to what I said before about the intervention that we made in March and the intervention that a number of central banks made. So we had reduced interest rates and put in a liquidity scheme a week before our second intervention in March, when we announced 200 billion of gilt purchases. Those announcements were primarily designed to deal with the market dysfunction that we saw, the dysfunction in government bond markets. And clearly the announcement of purchases, and we said we'd purchase at the fastest rate, the highest rate that was operationally possible, which we'd never said before. Normally, past instances of asset purchases, what we've done is announced a stock number and said we'll get there, by a certain period. At this point, we made an announcement about the flow and the speed of the flow, which was designed to basically destabilize markets. Now, asset purchases, I believe, have a monetary policy impact more generally through a number of channels, and there's now quite a large literature about what used to be called unconventional monetary policy, and one needs to think about withdrawal, from that position against a range of factors. But one of the factors you might want to think about was, given that this was an intervention that at the time was focused on the flow and on market dysfunction, it's possible that you may reach the conclusion that you would want to have a different view around the exit than you might have had with some of the more unconventional interventions that we've seen in the past. But I think, again, it's right that we try and talk about these possibilities. And I think Andrew talked about a May, and it's on, it's there to be looked at. But I wouldn't take from it a signal that decisions have been taken or whatever. It's another issue which will, like negative rates, we'll need to look at.
So I'm gonna switch again, which is this time it's kind of a responsibility you've had domestically in England, but now you have a big international responsibility, which is you are the chair of the Committee on Payments and Market Infrastructure. And this is an area where you could see the COVID crisis changing how we think about the cashless and contactless payments and so forth. So I guess maybe first of all, what are your priorities as the chair of the CPMI? And I guess secondly is, how do you see things changing, mainly driven by this COVID crisis?
So if Claire can answer that by the priorities I saw in January when I took over the post from Benoit Cœuré, and then to the extent to which the crisis has either changed or overlaid something on that. So I think a key priority for the CPMI remains the implementation and the full implementation of the principles for financial market infrastructures, and completing some of the reform job from 2010 and ensuring that those standards are implemented. It's one thing to draw up standards, but actually have to monitor the implementation of standards. And also the CPMI have been involved in trying to develop with IOSCO policies around cyber and cyber resilience. And we had some incidents in the SWIFT incident, which suggests the need to reform that. And that was kind of the existing agenda on the what I call the wholesale side. What was clearly going up the agenda as well was the need to look at payments, and particularly cross-border payments, in the light of not just technological developments, but proposals, for example, for stable coins that had just thrown the spotlight again on the cost, basically unreliability, lack of coverage, and inefficiency around the global cross-border payment system. And so there was a very clear mandate that came out of the G20 that, as well as kind of new developments in payments, new proposals, what could we do to improve the existing system? So I'd say the CPMI started off the year with a task force to look at how we might improve existing cross-border payment systems, and there'll be, I hope there'll be consideration of. With the FSB released one report in March identifying the frictions in the existing system, and there should soon be another report identifying what we might need to do to fix it. And it's not a simple set of issues. So those were the priorities going in. I think the CPMI was also looking at some of the other technological developments around the payment space, both on the wholesale and the resale side. What this crisis, I think, has done is actually reinforced those two areas. So we now have a real financial and operational stress, and we've seen how market infrastructure has responded to that stress. So I mentioned earlier on the need to go back 10 years on and look at CCPs and margin, just to make sure that while I think they operated well and did what they were supposed to do, which is provide people with insurance against counterparty credit risk. And for those of us that remember the financial crisis and the stresses and the gross margin flows, it's I think one of the things we didn't have this time around was those stresses. But we need to go back and ensure that the system is working as it should be and is not creating any additional pro-cyclicality. We've had an operational stress where the whole financial system moved to remote working. And again, I think there are some lessons we'll want to learn from that around resilience. So that part of the agenda that I talked about around the financial market infrastructure side, implementing the previous reforms, now looking to see how that's worked under stress, has now become even more important. On the other part of the agenda, the crisis has accelerated, I think, in many jurisdictions, the move away from cash. The amount of cash holdings have actually gone up, I think, for precautionary reasons. Households kind of drew cash. But cash transactions as a proportion of total transactions have gone down, in part because people have been using the internet more, but also e-commerce, but also in part, I think, because a number of, in many jurisdictions, a number of merchants and outlets have decided they don't want to handle cash because of people's fears about physical transmission. So I think those issues around payments and national jurisdictions, around the development and the speed at which electronic retail payments are developing, even low value, and the question then, what do central banks do when, as cash usage drops, or do they do anything as cash usage drops? Those questions have become kind of more important. So I think for CPMI, a focus on the infrastructure, how it's performed, what can we learn, what do we need, what parts of the job do we need to finish, and then on the payment side, again, changing nature of society, of commerce, so the way people transact. What does that mean for payment systems domestically, and what does that mean in a cross-border context?
Excellent. All right, and then here's a follow-up question that comes from the audience. I'll just read it. Does the Bank of England find that COVID-19 has accelerated digital projects? So you're talking about there's been an acceleration, but such as the CBDCs. I know that that's an issue that you and the Bank of England are studying right now, but has there been an acceleration in such projects such as this?
So, and that's what I referred to before. I think that's going to be increasingly an issue more broadly than the Bank of England, and there are aspects of that I think the CPMI will need to pick up. We published just on as the crisis just started at the end of February. We published a discussion paper on CBDC, central bank digital currency. We decided not to publish an open-ended set of questions or yet another analysis of central bank digital currency. There's plenty of that out there. So we published a straw man, as you would say, description of how some of the key design choices might be resolved and a particular form of central bank digital currency in order to stimulate people to say, well, no, that's not what we want, or actually there are dangers in that, or to say this will be useful, but you need to do the following. So it was quite it wasn't a blueprint for CBDC, and there's no decision, but it was more than just an open-ended set of questions. It was, well, here's what one could look like if you made the following design choices. What's the reaction to that? We're getting reactions in, and the discussion period is not yet closed. And then we'll evaluate that and see what that tells us about the purpose, the motivation for doing a CBDC, what that also tells us about the critical design choices. I'll make a number of points, though, about this. One is that this is not exclusively a central bank issue. I think that the nature of money, the way money is used in society, has large political ramifications. There are issues of privacy. There are issues of anti-crime measures. There are issues of inclusiveness. So in all the great debates in our history about money, and we tend to have a great debate about money every 100, 150 years, it's a difficult concept, money. It's a very useful one because we will use it, but the forms it takes in our society and economies change over time. Every time we have a big discussion about money, be it gold or metallic currencies or fiat currencies and the like, it's always a political debate as well, because money is actually kind of of huge importance to the way society functions. So though central banks are in charge of the money in their jurisdictions, those debates will go wider than central banks, and we'll have to see how others engage with it. The second point I'd make is we will carry on producing physical cash as long as people want physical cash. So this is not a question of, you asked whether the crisis has accelerated the change in cash usage. Our job is to provide the money that people, in the form that people want and are able to use. And as the way we, as I say, the way we live and the way we transact changes, that form may change. And we've seen a huge change in my life to electronic payments away from cash, which has just followed the way people want to transact and to operate. You couldn't have imagined using a credit card to pay for a coffee or a debit card to pay for a coffee 30 years ago in the way that people do now without thinking. And the last point I want to make is, as far as the bank is concerned, and I think this is pretty much true for all central banks, it's our job to ensure that the money that people use in their everyday lives is safe and they can rely on it. And they know what happens under stress, and they don't have concerns about the money they're using under stress. So no matter how it's provided, whether it's electronic, whether it's digital, whether it's blockchain, or whether it's paper, I think it's a responsibility of central banks to ensure that people can have trust and confidence in the money they use for everyday transactions. And that will cover not just how we think about central bank digital currencies, it'll cover how we think about sort of private versions of money. And I should say on private money, 95% of the actual money we're exchanging in society in the UK is claims on commercial banks. It's not state money in the sense of cash. But you have to ensure that however the money is provided, it's safe and people can trust it and rely on it.
Okay, I know we're getting close to the end here on our time, so I got a few questions on this, so I'm just gonna wrap them up into maybe two parts of a question, which is, so Brexit. There was Financial Times stories this morning about whether or not there's actually equivalence between the UK and the EU, which I find fascinating since I guess 6 months ago they were equivalent. So how do you see it as at the Brexit, and then kind of related, I guess, are you worried about a kind of more incremental downturn in the UK economy, first based on obviously COVID-19, but second also because of what may fall out from the Brexit discussions?
Okay, so on the financial sector, I'd say this has been thought about both in the public sector and in the private sector for a number of years now. Firms made preparations for a cliff edge at the end of the negotiating period, and I think we faced 3 cliff edges through 2018 and 2019. The bank's Financial Policy Committee has published and will continue to publish regular updates on financial stability risks and whether they've been mitigated. And I think the conclusion we came to before the last set of cliff edges was action had been taken to mitigate. There would be disruption, but the hurdle for financial stability was higher, and that action had been taken pretty much to mitigate most of the financial stability risks. So we'll continue to comment publicly on that. It may be that things have been changed by the COVID crisis, but I think the underlying fact that preparations, have been made over a number of years by public authorities and by financial firms, that will stand us in kind of good stead going into whatever we're going into at the end of the year. We know now there won't be an extension, but how the negotiations will play out, and it's not. I can't give you any view on that. On the equivalence question, we are actually still in the UK is still subject to EU law, even though we've left the EU, and we will be so at the end of December. So we are equivalent at the moment because we're in the EU system, and I think the aim from a regulatory and supervisory point of view would be to have, certainly from the UK, we've said this, would be to have a high quality, high standard set of arrangements for financial service activity between the UK and the European Union. Made very clear that equivalence, longer term, at the moment we have the same rules and regulations, but longer term equivalence needs to be based on equivalence of outcomes, not sort of textual equivalence and having the same rules. And that, I think, is generally accepted internationally. But it's also true that each jurisdiction has to have confidence in the regulation and the supervision of the other jurisdiction, because we import and export risks to each other. We have that with the US, for example, and other jurisdictions. So to my mind, it should be possible to reach agreement on those issues. But negotiations are also political, and there's lots of other issues in there. And I wouldn't want to comment on whether one can reach that. It's clearly not just a technical set of issues. I think the European Commission has said that equivalence can be determined for political reasons as well. So we'll have to wait and see. And on your final question, well, how do Brexit and COVID kind of interplay? I think we just need to know a bit more about what the endpoint at the end of the year is going to be, and how the crisis evolves. I think you can see changes in different directions, and what the net impact of that, I think at the moment is difficult to say. But once we have a clearer view of the outcome of the Brexit negotiations, and once we have a clearer view around the evolution of the COVID crisis, and particularly those areas of uncertainty around the management of the crisis and the policy measures that may need to be taken or may not need to be taken in the second half of the year, then I think it'd be easier to reach a view on that.
So John Cunliffe, thank you very much. You've been very kind with your time. And at the top of the hour, I know that our chairman, Axel Weber, will be interviewing John Williams, who is the president and CEO of the Federal Reserve in New York. Again, John Cunliffe, thank you very much for helping us out today, and appreciate it.
Okay. Thank you very much.
Bye.